Good evening. My name is Josh Blank, and I'm a professor here at UCI Law. I teach tax courses at the law school, and I'm very proud and happy to be a member of the faculty of the graduate tax program. If you've been following the news coming out of Washington, D.C. lately, it should be no surprise to you that tax reform has become the subject of intense focus on Capitol Hill. It feels like it was just yesterday, December of 2017, that we received the most significant legislative tax reform package in about 30 years. And it appears that we are again at the precipice of major changes in the tax law. Tonight, my colleagues, Professor Omri Marian, Vic Fleischer, and I will provide an overview of the Biden-Harris administration's recent tax legislative proposals, including in the American Jobs Plan and the American Families Plan. Professor Vic Fleischer will review the administration's domestic tax proposals. Professor Omri Marian will review the administration's international tax proposals. And at the end, I'll say a few words about legislative proposals involving tax compliance and enforcement. After the presentation, we'll answer questions from the audience. So if you have any questions, please type them into the Q&A feature, and hopefully we'll have time at the end as a panel to address your questions. But first, let me introduce my co-presenters this evening. Professor Vic Fleischer. Professor Fleischer is a professor of law here at the law school at UCI. Previously, he served as a professor of tax law and the director of tax programs at the University of San Diego School of Law. He served as the Democratic Chief Tax Counsel for the U.S. Senate Finance Committee from 2016 to 17. Professor Fleischer teaches and writes in the areas of corporate tax and international tax, partnership tax, tax policy, and alternative investments, and he's published widely in these areas. Professor Omri Marian is professor of law and the academic director of the UCI Law Graduate Tax Program. He is an internationally recognized expert in international taxation and comparative taxation. Before joining UCI, he was an assistant professor of law at the University of Florida, where he taught in its graduate tax program. Professor Marian's work has been cited by Congress and actually by the Treasury Department and its tax compliance agenda that it just released a couple hours ago. And he's frequently featured in financial media outlets. So thank you all for joining us to talk about the Biden-Harris tax proposals. With that, I will turn it over first to Professor Vic Fleischer. Take it away, Vic.
Thanks, Josh. Let's dive right in. So this is just an overview slide of what's happening now. And the administration has released its American Jobs Plan and American Families Plan, and each of those proposals has a tax agenda attached to it. So these proposals are now moving over to the Hill, where Congress is sure to make its mark. And the most of attention at the moment is focused on the international provisions. I'll talk about the individual provisions first, but certainly on the Hill, there's major changes that are being discussed with respect to the international tax framework. And all of this is happening while the OECD is doing its own negotiations, and the US has re-engaged with the OECD in that process. So you kind of have the domestic agenda, domestic legislation that's being considered that's going to have an impact on the international framework at the same time that you have this OECD process that is continuing and will continue throughout the summer. It makes things pretty hard to predict. So that's a quote there from Senator Bill Bradley in one of the greatest textbooks ever written, Showdown at Gucci Gulch, which talks about the Tax Reform Act of 1986. I think we're in a similar position now. Maybe the scale is not quite as grand as the Tax Reform Act of 1986, but it's pretty big, especially in the international arena. And I think it's going to be a very interesting process while the Senate, the House and Senate respond to what the Treasury has proposed. And the backdrop here is a closely divided House with a slim Democratic majority, a 50-50 Senate. And so it's going to be very tense as the administration tries to move these proposals through Congress. So we'll start with a little overview on individual and capital gains policy. I'll then turn it over to Omri for corporate and international, and then we'll Josh will finish with enforcement, and then we'll open it up for Q&A. I think one of the reasons we're so excited about these proposals is they're coming from our friends. These are people we've known for myself almost 20 years. So it's exciting to see, and not just because it's our friends, but this is stuff that has been worked on for the last several years in academia. The reason that the Treasury Department was able to move so quickly is because Professor Kaiser, Professor Klausing, Professor Grinberg, they've all been working on these proposals in their academic capacity and on the transition team, and then they translated very quickly into proposals that could come out of the Office of Tax Policy. So all that said, I mean, I think these proposals have been thought through, but that said, a lot of the details remain to be worked out, and that's going to be worked out largely on the Hill. Because the Senate is 50-50, I think the working assumption is that this is not going to be a bipartisan effort. At the end of the day, I think there will be maybe some bipartisan discussions, but at the end of the day, I don't think anybody's counting on Republican votes materializing. Maybe one or two on, from folks like Senator Collins or Senator Murkowski, but it's likely to be almost entirely Democratic votes, which necessitates the use of the budget reconciliation process, which allows you to avoid the filibuster in the Senate. So in this budget reconciliation process, there are lots of rules that I can talk about in the Q&A if people are interested in. But as a practical matter, what that means is that the Senate Finance Committee is likely to have a lot of influence on getting this legislation through the Senate, and ultimately going to have a lot of influence on what the legislation looks like. So let me start with the broader theory of the case before I go into the specific individual and capital gains policy provisions. The broader theory of the case here is we all agree that we need to strengthen our infrastructure. And Democrats take the view that the 2017 tax bill was a little bit of a rush job and created some significant problems, significant gaps in our international tax framework. And as a result, US multinationals continue to shift paper profits offshore and avoid paying US tax. So we need to strengthen this international tax environment by broadening the base, ending harmful tax competition, or better known as ending the race to the bottom in international tax. And there's also a sense that we can pay for things by increasing taxes on the wealthy, particularly through changes in capital gains policy and increases in enforcement at the high end. But all of this is going to be constrained by the budget reconciliation process. So I think what we've seen from the administration so far is kind of an opening bid. And then the next stage of the process will be a back and forth between Congress and the administration. And in particular, the moderate Senate Democrats are going to, I think, force the administration to scale back some of these elements, as we'll talk about. I think I'll just touch briefly on process, and obviously I can go in more detail if people want in the Q&A. The initial thought here is to have two different budget reconciliation bills. The first one would be the American Jobs Plan with the corporate and international tax provisions attached to that. And that would be moving maybe in September or October. And then later in the calendar year, the American Families Plan, which has the the individual tax, capital gains policy, partnership tax provisions in that. The theory here, I think, is that the administration wants to start with the stuff that polls really well. And if you look at any polls, they're going to tell you that taxing corporations and taxing the wealthy people to pay for infrastructure, that polls really well. It's very popular. And so that would be the reason for starting with that. The flip side of that is the tougher, if you take infrastructure and the corporate international tax and get it passed in the first bill, whatever's left over is going to be that much harder because you've taken some of the politically popular stuff and voted on that first. So there's some division of thought about how to proceed, and we'll see how that develops. So the American Families Plan is the part of the administration proposal that addresses the so-called caring economy more than traditional physical infrastructure. So these are things like education policy and community college for all, and childcare and all of that. And so that is being linked with these potential tax increases. And the Biden administration has stated that it wants to avoid raising taxes on families earning more than $400,000, earning less than $400,000. So it really wants to target wealthy taxpayers. So the proposal here would be to increase the top rate on ordinary income to 39.6%. That is the same rate that we had in the Clinton years, so it's not an outrageously high number. I think the much more significant change and where we're going to see the biggest fights have to do with capital gains policy. So under current law, capital gains are taxed at a 20% rate, along with Medicaid tax of 3.8% that applies to some investment income. The proposal here would be to increase the capital gains rate to 39.6, which would equalize with the ordinary income rate. I think that's a smart policy, but I don't think it's politically likely to happen. I think more likely we might end up with a capital gains rate under pressure from moderate Democrats landing at something like 28%. The reason I say 28% is for tax nerds, it kind of sticks in our heads. 28% was good enough for Reagan in the Tax Reform Act of 1986. So if it's good enough for Reagan, it ought to be good enough today. The biggest change here is actually not related to the rate. The critical move here is the administration has proposed to end the so-called step up in basis at death. And so they would do that by treating disposition of appreciated property by gift or bequest as an income tax recognition event. So I'm sure as you all know, if you hold appreciated property, let's say you buy stock with for $100, and 5 years later you sell it for $1,000. So you have a $900 gain. If instead of that, you hold on to the property, you don't sell it, and you give it to your heirs, when you die, your heirs take that with a basis of $1,000, as if they had bought the stock for $1,000, and that $900 of gain disappears. So that's the so-called step up in basis at death. The administration wants to get rid of that and instead treat the disposition by gift or bequest as a recognition event, so that you have to recognize income tax. The reason this is so important is if you don't change the step up in basis at death and you raise the capital gains rate, then people have a really strong incentive, an increasing incentive to hold on to that appreciated property until they die. And so the revenue maximizing rate for capital gains, if you don't change the step up in basis at death, is something in the neighborhood of 26, 27%. And so, it's really important, if the goal here is to raise some revenue, that we end the step up in basis at death. That will allow us to increase the capital gains rate and raise some revenue. In my own research, I've focused a lot on how a lot of what is treated as capital gains under current law is really labor income in disguise. So it's not just portfolio income when we talk about capital gains. A lot of that is things like carried interest and founder stock that is really labor income of a sort, but is taxed at capital gains rates. And so if you think it's important to tax the founders of Amazon or Facebook or Google on all of that appreciation in their founder stock, it's really critical that we end the step up in basis at death, and that would allow us to increase the capital gains rate and actually capture some of that income. A couple of other things in the American Families Plan. The administration wants to tax carried interest as ordinary income. So that's not terribly important if the capital gains rate goes up to 39.6, but if, as expected, the capital gains rate is somewhat lower, then carried interest is, as I mentioned, in my view, it's a form of labor income in disguise. Carried interest is the 20% share of the profits that investment fund managers get for managing the fund. So this is not carried interest reform here is not going to the investors, changing the tax rate for investors in venture capital or private equity. It's just the fund managers that would be affected by this proposal. And Senator Baldwin has released the most recent version of that legislation. Interestingly, maybe already has Senator Manchin as a co-sponsor. So I do think that's significant. Maybe I'll skip over the net investment income tax. The administration wants to repeal Section 1031, which is the like-kind exchange for real estate. What's sort of funny about that one is, it's certainly good policy to pursue. There's not that much revenue in it. It's sort of surprisingly, the revenue estimate's kind of low. So that's one of those things that could disappear in negotiations as we go. So I haven't talked about some big questions. Maybe some of these will be answered in the Green Book, which is the administration's budget proposals, and that's expected to come out. We think by the end of next week, and this is a change. The Trump administration did not release Green Books, did not write Green Books, so it's great to have more information coming out of the administration. There are going to be some things that are not in there that one might expect. So there's certainly a lot of interest in repealing the cap on state and local tax deductions. That's certainly an issue for a lot of folks in the House of Representatives who've been raising this. It's certainly an important issue for us in California. I don't think it's going to be in the Green Book. It doesn't mean it's not going to be on the agenda as this moves to the Hill. Similarly, Section 199 Cap A, the so-called pass-through deduction, I'm not sure that's going to be in the Green Book, but I do think it's going to be on the table as a revenue raiser later in the summer. So I think as we talk about these proposals going forward, people are aware of and people are talking about things that are not formally in the Green Book, but they're very much going to be in the discussion as a sort of practical matter. The House and Senate are going to have to pass a budget resolution that's going to set target numbers for budget reconciliation. So that will provide instructions to each committee, including the Senate Finance Committee, saying, we want you to raise revenue by a certain amount. And once that number is set, as a practical matter, it's a little bit hard to move it. And so there will come a time later in the summer where Democrats are looking for revenue raisers to try and hit that target. And so all of these things are going to come onto the table. And one of my, desires is that Democrats shouldn't feel like we have to pay for everything. There's the opportunity to raise revenue through just borrowing or through the Build America Bonds program. But very good chance that we'll also be looking for some additional tax revenue offsets, particularly as the administration makes some compromises in the capital gains rate, makes some compromises in the corporate rate and GILTI rate, as we'll discuss. So all of these things are going to be on the table later in the summer, even if they're not formally in the proposals that we've seen thus far. So why don't we hand off now to talk about corporate and international. Omri.
So Next slide, please. So I'll start by just noting that there are a lot of acronyms in the plan and in the code. So there is a lot of nuanced detail. I'll try, given that not all of you are tax professionals, which is good because we want not only tax professionals to understand what the administration is doing. I'll try to simplify and avoid the nitty-gritty details of the law and the reform, but I'll have to explain a little bit. So brief overview of what's in the business side of the proposal, in particular with respect to corporate tax and international tax. So first, the corporate tax rate has been reduced at the end of 2017 from 35 to 21. The administration want to bring it up to 28. The Tax Cuts and Jobs Act took stick and carrot approach to international taxation by creating something that is known as GILTI, Global Intangible Low Taxed Income, which is basically a minimum tax on foreign income earned by US corporations. And when I say foreign income, what I really mean is shifted income, basically paper profits that are shifted into low tax jurisdictions. And in addition, there was a carrot, which is basically a low tax on export income from exporting from export related to intellectual property that is in the United States. I will elaborate a bit more on that. The other thing, and the administration doesn't like both the guilty thing and the other, the FIDI, which is the carrot side of the equation. In terms of trying to prevent foreign investors from stripping out their income earned in the United States, the Tax Cuts and Jobs Act introduced something that is known as BEAT, Base Erosion and Anti-Abuse Tax. And the administration doesn't like that for reasons that I will explain in a second, and want to replace it with something that is called SHIELD. Now, everything that I mentioned so far is domestic. We're talking about international, a change to domestic law that is applicable to cross-border transactions. But we cannot really disengage what's going on right now in the United States than what's going on in the international tax arena worldwide. So these days, the OECD, the Organization of Economic Cooperation and Development, is heavily engaged in a project to, let's call it, revamp international taxation, the taxation of cross-border transactions. There is something that is called the inclusive framework that most countries in the world are in one way or another signed on to. And the OECD has offered a revised approach to international taxation, something that is known as Pillar 1 and Pillar 2, which I will also explain in a bit. But it is pretty clear that the administration takes that into account and even takes some of the idea that Pillar 1 and Pillar 2 that are suggested by Pillar 1 and Pillar 2 and adopt them into domestic law. And I can't overstate how important that is. This represents a major shift in the US administration approach to international tax matters. Before the current administration, under the Trump administration, and even under the Obama administration, United States took a much more secluded approach to international tax. Both administrations, basically, both previous administrations basically took the view that United States domestic law is already adheres to the new international standards that the OECD is trying to implement, and we don't have to do much, which was, as a factual matter, I think, when you actually look at the law, was wrong. But there are lawyers, you can always make the case that you're right. But what we're seeing right now is a complete change in approach. We can see it in Secretary Yellen's op-ed recently in the Wall Street Journal, which seemed like it has been at least approved by OECD speechwriters. It is not very surprising given the change in the staffing of the administration I think. Let's start with the corporate tax rate. As I said, the proposed rate is 28%, which seems a rather hard pill to swallow for moderate Democrats. The administration already made it pretty clear that they will be fine with 25%. And I suspect that this is where we're going to end. 25% is something that is relatively easy to sell to moderate Democrats. Next slide. The next thing in the international tax arena is how to address the issue of profit shifting. Again, just let me briefly explain what I mean by profit shifting. The idea of profit shifting is that there is income that for tax purposes is booked in a jurisdiction that is not the jurisdiction where the actual economic activity takes place. Neither it is the jurisdiction where the taxpayer meaningfully resides. And with some paper shuffling and good lawyers that do the paper shuffling, you can make earnings appear in all kinds of low tax jurisdictions, even though this jurisdiction had nothing to do with the generation of the earnings, which is something that is increasingly easy to do in a world where most income is attributable to some kind of intellectual property rather than brick and mortar activities. It is a well-known problem. We're talking about trillions of dollars each year that US multinationals park offshore. There is an argument whether it's good, bad, but I don't think that there is a real argument that it happens. The Tax Cuts and Jobs Act, in the Tax Cuts and Jobs Act, Republicans actually did try to address it, but the view of the administration, and I think of many tax experts, is that this was very much like unsuccessful patchwork that didn't prevent income shifting. And it's no coincidence that the two papers that argue this on this slide were written by two people that are now in the administration. These are the view that these academics took before they been in the administration, and now, surprise, surprise, it is the view of the administration. So let's start with the outbound view of things. Basically, the idea that US multinationals park a lot of their income offshore and are not paying tax on it. So as I said, the Tax Cut and Jobs Act created what is known as a carrot and stick approach. The stick was GILTI, Global Intangible Low Taxed Income. And what GILTI basically does, it imposes immediate taxation on income of foreign subsidiaries of US multinationals to the extent that such income exceeds what we may call a normal return on foreign assets. So we look at the foreign assets the subsidiaries have, add some normal return. Any income that subsidiary has on top of that is subject to minimum tax at 10.5%. The administration really doesn't like GILTI as is for basically three reasons. First is that 10.5% is still much better than 21%. So even if you are hit, you get hit with the full 10.5% burden of GILTI, you still have strong incentive to shift income offshore, because it's better to pay 10.5 offshore than 21% in the United States. The other thing the administration doesn't really like is what is known as cross-crediting. Right now, the way that the GILTI is calculated, basically we look at all the income that US multinationals book offshore as one basket. In that, this means that I can average income that I earn in high tax jurisdiction like Germany with income that I earned or shifted into a tax haven like Luxembourg, for example. So on average, the tax rate, basically what happens that the income from Germany kind of averages out the no tax in Luxembourg, and it helps me to avoid the full burden of GILTI. And the other thing that the administration believes is that guilty creates an incentive to move tangible assets from the United States abroad. And even if not move tangible assets abroad from the United States, it creates an investment to an incentive to invest in new tangible assets abroad. And basically the argument goes that because guilty is only imposed on excess return, then the more assets you have abroad, the higher the threshold is before you get hit with the guilty. I don't know that there is I understand the model. I personally don't know that there is empirical evidence that shows that this happens, but this is what the administration believes. So the idea of how to change guilty basically addresses all three issues. First of all is to increase the rate from 10.5 to 21, which is going to be much closer to the corporate tax rate that is going to we're going to have. So if it's 25, for example, the difference between 21 and 25 is not as significant as the difference between 10.5 and 21. So this significantly reduces the incentive to continue to shift income. The second is to eliminate the QBI. QBI is qualified business assets. So basically to eliminate the threshold requirement for the excess return, because if we ignore the assets, we no longer have the incentive to move to shift income offshore. And finally, and personally, I think that this is the most significant change that the administration offers in respect of guilty, is to prevent the ability of cross-crediting or averaging between high and low tax countries. And the administration proposes to do so by doing the guilty calculation on a country-by-country basis. So basically, any country where you pay below the guilty rate, you will get hit with additional tax. The next part is the FDII, or Foreign Derived Intangible Income, which is the current side of things. So basically what the Tax Cuts and Jobs Act did there is to try to create an incentive to US multinational to hold their intellectual property in the United States by offering reduced tax rates on exports of IP. So basically, instead of paying the 21% rate corporate tax on income from intellectual property, if the income was a result of export of intellectual property, for example, receiving royalties for allowing a subsidiary to use the IP in Germany, basically. So the low tax rate was 13.125. The reason why it is so weird is because after you account for foreign tax credit, it actually brings you to effective rate of 10.5, the same as the guilty rate. And the way that it works is, again, you look at certain threshold of assets, right? So I have tangible assets in the United States. I have fixed return, 10%. Any income from IP above that, any income from above that is assumed to be FDII income, and I get the beneficial tax rate. The administration didn't like that very much for several reasons. First and foremost, there is no substance requirement. All you really need is to export IP. You don't actually have to do the research and development in the United States. All you really need is to hold the intellectual property in the United States, which is effectively a piece of paper. And the administration doesn't like that. The administration wants to incentivize R&D in the United States directly by giving direct subsidies for R&D that actually happens on the ground in the United States. The administration still didn't say how they're going to do that, but basically, I think most of us agree it means some additional deduction or credit for specific activities that happen on the ground in the United States. Another reason that the administration doesn't like it, again, because you only get the benefit of FDII above certain threshold fixed return of assets that in the United States, it creates an incentive to locate the assets offshore. So you reduce the threshold from which you get the beneficial treatment. And finally, there is a pretty strong argument that it is an export subsidy which violates United States commitments under trade agreements. So what the administration offers to do is basically to abolish it. Just get rid of foreign derived intangible income altogether. There is, I will note a bit later that there is also an offer on the table, a proposal on the table from Senate Democrats, which is a bit different, and I will note the differences in this proposal. The next aspect is inbound taxation. So in theory, what we're talking about here, we're talking about foreign investors that invest in the United States, make money in the United States, and then usually through deductible payments to outbound deductible payments to the parent in the foreign jurisdiction, strip out the tax base in the United States. The issue has been addressed in multiple ways in the past, mostly unsuccessfully. We really have, I spend probably a third of my international tax class every year of the semester covering all the different anti-earning stripping rules that we have to try to prevent it. And the reason we have so many is because none of them actually work very well. What the Tax Cuts and Jobs Act tried to do is to create one big rule that addresses the issue. This is the BEAT, the Base Erosion Anti-Abuse Tax. And this basically imposes certain minimum tax on payments to related parties. The way that it does it, basically we take your tax base and we recalculate it as if you didn't make these payments to related parties, and then we tax you at a minimum amount. So it's kind of like alternative minimum tax for corporations. The problem with BEAT, and I think it doesn't work very well, is that first of all, the scope is very limited. It's only applicable to very large corporations, corporations with a gross income in the United States of $500 million. There are, I know, a few dozens corporations that do that have such a huge market in the United States. And it also does not take into account costs of goods sold, and it also kicks in only if certain threshold is met, that at least 3% of all your deductions are attributable to payments to related parties. And also, I should say that US multinationals have been very successful and creative, again, thanks to lawyers like us, at avoiding the BEAT using mostly something that is known as the check the box regulations. So the bottom line, the administration views the BEAT simply does not work. So what the administration wants to do is to replace the BEAT with SHIELD, which I knew what the acronym was before we started, but it's too many words. It's something, stop harmful inversion and something development. I can't remember the acronym, but it was obvious that it was, they first came up with SHIELD and then figure out what the acronym is going to be. And SHIELD, at least as we have almost no details, I have to say. What the administration basically, but it's the idea is rather simple, is any payment that is made to a related party in a jurisdiction that doesn't tax such payment at a minimum amount is not going to be deductible in the United States. Today, we learned when the administration came out with the proposal, there was no tax rate. Today, we learned that the administration is okay with 15%. This is going to create all kinds of weird incentives because multinationals operating in the United States basically are going to have three rates they're going to have to take into account: 25%, the corporate tax rate; 21%, which is GILTI; and 15%, which is the shield rate. It's going to be interesting. A few words on the Senate Finance, the Democrats in the Senate Finance Committee. They offered their own plan for international tax, but it is somewhat different. I will say that they said, and I agree, that both ships sail in the same direction, both the administration proposal and the Senate Finance Democrats proposal. But I think it will be, it won't be unreasonable to say that the Senate Finance proposal is a bit more tame. It's not as extreme as the administration proposal. So in respect of GILTI, they offer another option other than the country by country calculation. So they suggest, instead of making the country by country calculation, we'll just have two buckets for high tax countries and low tax countries, and you cannot just cross average between the two baskets. I will not discuss Altera. In terms of the FIDI, which is again the carrot approach, they don't offer to completely eliminate FIDI. They want to tweak it, replace it, improve it. They didn't actually say how. The one thing that comes across from the language in their proposal is what they seem to care about is that there is going to have to be some substance requirement in order for multinationals to enjoy FIDI. So there needs to be something on the ground. They just didn't explain what it is. And finally, they actually don't offer to replace the bit. They offer also to tweak the bit. Mainly what they're trying to come up with is basically have a two-tier bit rather than just one minimum tax rate, which is 10%, by the way, for the bit, to have a progressive bit. So if you avoid too much income, then we tax you at more than 10% minimum tax. So we're going to have progressive bit. I personally think, well, I didn't see the shield, so I don't know what I personally think. I'm not sure which one is better. It's pretty clear that the bit as is doesn't work very well, so I'm not sure what just adding another bracket is going to do to it. Now, as I said, we cannot truly ignore these proposals in the context of the bigger international tax picture and what the OECD is doing. And as I said, that this is a major change in US approach to international tax negotiations. And what the OECD currently offers is basically an approach that is comprised of two pillars, which you can say this is one outbound and one inbound, similar to the way I described everything so far. So OECD Pillar 1 basically is about how we tax at the market jurisdiction in the age of a digital economy, where you don't necessarily have presence on the ground, you just sell into a jurisdiction. So basically what Pillar 1 is trying to do is trying to solve this by creating a weird formula. Well, I don't know if it's weird. It's complex, though. Next slide, Dick. A formula to basically tax in the market jurisdiction, allow the market jurisdiction to tax above normal returns. Now, if this sounds familiar to you, it's because this is what GILTI basically does in kind of a twisted, well, not twisted, but kind of a different way. The sticking point on Pillar 1 was that, first of all, the United States really said, we have GILTI, we don't need this. And Secretary Mnuchin, what he said is basically, let's try to have use Pillar 1 as a safe harbor, which basically what it meant is that companies will elect into it only if it reduces their tax. And this was a real sticking point between the United States and the OECD. And this had changed dramatically with an offer that the Treasury put out to the OECD about 2 weeks ago, which basically what the offer does is narrowing the scope of the of Pillar 1 only to very large corporations. But other than that, the concept remains. So it narrowed the scope and simplifies the formula by having the calculation based on fixed known elements like gross revenue or assets or stuff like that. And the reason why you see Itai Greenberg's picture there is because he offered it before he went to Treasury in a tax notes article. So what you see, design a scope limitation of OECD Pillar 1. If you read the slides that the Treasury shared with the OECD, you feel like you're reading a summary of Itai's article. So I think he's behind it, even though no one will tell us, but it's pretty clear that he's behind it. But this has been very well received by the OECD. As far as the OECD is concerned, the United States is back at the table, and it seems that this is true. Pillar 2 of the OECD is about creating some sort of global minimum tax, which seems similar to one part, at least in one part, it is similar to what the Shield does, which basically denies deductions for payments that are going into low tax countries. One of the things that Shield does, because the size of the market is so big in the United States, it actually creates incentive to all other jurisdictions that were kind of on the fence with the OECD Pillar 2 proposal to actually join in. Because otherwise they cannot tax payments earned by their own residents all they want. If they don't do it, the United States will tax it. So it's better to them to join and actually get some of the revenue. And if they do it anyway, basically they're part of Pillar 2 of the OECD. So I think that the combination of Shield, which puts the United States in line with the global minimum tax proposals, and Guilty, which really kind of brings United States very much back in the table in the context of Pillar 1, means that the United States once again is taking an effective and probably leading role in formulating international tax policy, which I think is probably good for us. And that's it, I think. That's what I have to say about international taxation.
So thanks very much, Omri. I'll just say a few words about the administration's proposals in the tax enforcement area, and then we'll open it up for broader discussion. So the first point on the slide that you see is the number $80 billion. President Biden has proposed giving the IRS $80 billion and more authority over the next 10 years. The purpose behind this, first it's necessary to look at the history. Over the last decade, the IRS has had significant budget cuts. The enforcement staff was cut by 30%. Audits of the largest corporations fell by 50%. Audits of millionaires fell by 80%. So the purpose behind this proposal is to try to rebuild the IRS. Specifically, the administration tells us that the purpose of this increased funding is to modernize technology to help the agency identify tax evasion, to hire and train auditors, and to improve customer service. And one just more general purpose is to close the tax gap. The Commissioner of Internal Revenue, Chuck Rettig, testified that even though the IRS usually refers to the tax gap as somewhere in the $400 billion range, it's possible that it is $1 trillion a year, the US tax gap. And some commentators questioned exactly where that figure comes from, but a number of commentators also agreed that the tax gap may be a lot higher than what the IRS has reported each year. The Treasury has proposed that if you take this investment and think about what it would do in terms of revenue. If you look at the next decade, the estimate that the administration provides is that it would generate $700 billion over the next decade. And over the decade after that, the second decade, the estimate from the administration is that it would generate 1.6 trillion in net revenue. One focus of the boost in funding would be to increase enforcement specifically against high-income taxpayers. Again, according to the administration, as a result of budget cuts and attrition of IRS agents and lawyers, the audit rates on those making over $1 million per year fell by 80% between 2011 and 2018. And so the administration is going to be very focused on high-income taxpayers, and that's one of the purposes that it has said this increased funding would serve. The Biden administration also proposes giving the IRS greater authority to regulate paid tax preparers. Tax returns prepared by certain types of preparers have high error rates, and these preparers charge taxpayers large fees. Lawyers and accountants undergo training, they have licenses, they help clients file tax returns after receiving these things, but there's another group of preparers that's not licensed and not regulated. Instead, they can obtain a preparer tax identification number through the IRS, which is very easy to get. So President Biden has issued a call to Congress to give the IRS authority to have greater oversight over these paid tax return preparers. One of the administration's enforcement proposals that's receiving a lot of attention is its proposal to introduce third-party reporting by banks and financial institutions to the IRS. And the basic idea is that these banks and financial institutions would report gross inflows and outflows in different accounts to the IRS. So what's behind this proposal? We're getting a little late in the evening, so I think it might be an appropriate time for a tax joke. I do have a great tax joke. I wish we were all together. It's one of my favorite tax jokes. I remember, this is true, working in a law firm, my first job out of law school, and I was sharing an office with another tax associate. And I got my first paycheck. It was that first week. And I couldn't believe it. I still had debt to pay off. And this was the first time I saw a check like this. And I was very happy. And the associate I was sharing an office with saw this and he said, "You look pretty happy." I said, "I am. Were you happy when you got your first paycheck here?" And I remember he said to me, "Well, I remember it. And when I got that first paycheck, the first half was great." Now that's hilarious because I know if we were all together, this would bring down the house. The second half was missing. It was just gone from the paycheck. And it was gone because of withholding. It was taken away and sent to the government. And also there was information reporting. And the information reporting told the government exactly what my friend, the associate in the office, had been paid. So if you've ever received a paycheck as an employee, there has been third-party information reporting, and the IRS knows what you were paid. As a result, the compliance rate when there's information reporting is greater than 90%. When there's information reporting and withholding, it's greater than 95%. So if you take all of that and think about people who aren't employees, what is the tax compliance rate in that situation? If instead you own your own business and you're not an employee, there is much less information reporting, maybe even none. Even if you have money in a bank, there might be reporting of the interest on the bank accounts, but there's not much else. So this proposal would attempt to even the playing field by requiring financial institutions to report information on account flows so that earnings from investments and business activity are subject to the type of reporting that wages are currently subject to. It is designed to leverage information that financial institutions already know about their account holders simply by requiring that they add to their annual reports aggregate account outflows and inflows. This proposal, as I'm describing it, is something that the administration has put forth. It was also offered by three scholars and former government officials, Natasha Sarin, Larry Summers, and Charles Rosati. And one of these individuals, Natasha Sarin, is currently in the administration. And this proposal looks very similar to what they outlined most recently in a tax notes article. The proposal has not been without criticism. I'll describe some of it. One is criticism that a commentator mentioned just in the last week. The Treasury suggestion that this is just something that can be done easily by banks is fanciful. That's the criticism. This is not what banks currently do. More blunt criticism comes from a commentator, Lee Shepard, in Tax Notes. She wrote that bank account reporting would be a grotesque invasion of individual taxpayer privacy, even if it were not unconstitutional. It would not be justified by the relatively small asserted revenue pickup or any other conceivable tax policy. She also notes that personal accounts are supposed to be excluded. Most business owners do have separate business accounts, but how will banks be able to tell that? Another point that some critics have raised is that by statute, the IRS is not permitted to conduct what used to be called lifestyle audits. If the IRS heard that somebody is suddenly driving a Rolls Royce but doesn't seem to file tax returns showing very significant income, that might be a clue that there's something going on. By statute in the Internal Revenue Code, the language in the code says that financial status or economic reality is not something that the IRS can use to conduct an audit unless there's a reasonable indication that there's some type of unreported income. The response to all of this criticism is, well, first, the image of the mom and pop pass-through business that gets affected by this proposal is actually not realistic. The top 1% receive 70% of the pass-through income. Also, the response to the critics is that the IRS can use this information to spot suspicious patterns, not conduct lifestyle audits. If there are significant inflows and outflows, but no tax return filed, that's suspicious. Another response is that banks may not provide this information to the IRS currently, but they certainly provide it to customers. When you get this thing called a bank statement, there's information about the outflows and inflows. And so the whole idea behind the proposal is that it will make it harder for people to cheat. It will subject the inflows and outflows in bank accounts to the same type of reporting as my friend sitting there in the office making the tax joke at the beginning, the same information reporting as wages. Now, hot off the presses, the Treasury, right before we had this webinar, so you are getting very current information, released the American Families Plan Tax Compliance Agenda, which is about 24 pages, and it's much more detailed than what we've seen in the fact sheets from the White House. And you can find this on the Treasury website and on Twitter. They're publicizing it as we speak. And there is some additional detail that we were thinking about. We didn't know what the answer was. One big question is, how is this going to work in terms of the reporting by financial institutions? Tonight, the Treasury says, if you think about what you get every January, if you have a bank account, Form 1099 int, which just describes the interest that you have been paid during the year, that form is the mechanism that the Treasury anticipates would be used by financial institutions. Financial institutions would simply report additional data on the financial accounts of these existing information returns. And I'm reading now from what the Treasury says tonight. Specifically, the annual return would report gross inflows and outflows on all business and personal accounts from financial institutions. So that's actually new from what we had heard, because personal accounts are described in this Treasury plan. And it says including bank loan and investment accounts, but there will be carve-out exceptions for de minimis gross flow amounts. So there is going to be some type of a carve-out. We don't know exactly the amount, but this is a very broad proposal. Another question that you might be thinking about is, we're hearing so much about cryptocurrency. One of the benefits of cryptocurrency in terms of tax avoidance or tax evasion is that it's not subject to information reporting. It's a place where there is a lot of secrecy. So one question might be, won't taxpayers suddenly realize if bank accounts are subject to this information reporting, they've got to put their money somewhere else? Maybe cryptocurrency becomes even more attractive because of the fact that everything going on there is so hidden. Well, again, hot off the presses, in the Treasury's detailed description tonight, it says everything I just described about the reporting by banks. It says the reporting regime would also cover foreign financial institutions and crypto asset exchanges and custodians. So the Treasury is thinking about possible ways to get at cryptocurrency in terms of a way people might try to avoid the information reporting. And there's a lot of other discussion of cryptocurrency in this report from Treasury tonight. So I would recommend the report to learn more about what their plans are. The last point that I'll make is scoring issues. The final issue that is related to the legislative process is how to account for the assumed new revenue that this investment into the IRS is supposed to create. The CBO and JCT may conclude a substantially lower revenue amount than what the administration has proposed. The Penn-Wharton budget model estimated that the Biden-Harris proposals in terms of IRS enforcement would raise about $480 billion over a decade, which is a lot less than the $700 billion the administration has proposed. This, we can talk about maybe more in the Q&A, creates problems if the administration wants to use the reconciliation process to pass its legislation. Figuring out what is the amount of that expected revenue raises a number of interesting legislative questions. So this is the end of our formal presentation, and we have some time left now just for some discussion among the panel. And I would, again, just ask if anyone has questions, please type it into the Q&A. We can see these live as you're doing it. And some of you also asked questions earlier before we started our event. So I'm going to start with one of the questions we received from multiple people.
Can I just say
yes,
one
please.
thing?
Yes.
One of the things that was on the slides, but I completely neglected, and I'm not sure how is another, other than the corporate tax rate, the Biden administration offers a minimum tax on book income, on financial, basically financial statement income. This is a big deal. I have no idea where this is going, because this to me seems like a heavy lift for the administration, but this is also a major proposal, which was on the slides. I just didn't read it.
Well, I dissent, I guess, from that view. I don't think it's a big deal because I think it has close to zero chance of proceeding. So that's why I haven't been emphasizing it when I've been presenting this.
Okay.
And we should say, as a caveat, these are all proposals. Everything we have been describing are proposals. This was not a summary of the law. These have not been enacted. We do have a sense of what the administration wants to prioritize, but these are all proposals. So why don't we just start with the first question that we received from several people. I'll throw it out to the panel. One question that we received is, I am thinking about my state and local taxes. And if I'm in California, these are very significant compared to people in the rest of the country. What's the likelihood that Congress, as part of this whole process, will remove the $10,000 cap on state and local taxes? We hear a lot about this in terms of the whole political process. Maybe Vic or Omri, if you have any thoughts on what you think might happen. I'll just mention right at the beginning, one thought I have when I hear this question is, if you take a map and you compare the state and local tax burden of all the states in the United States, you start to see very dark areas on the coasts. And then if you layer on top of it the Electoral College map, they look very similar. This is one reason I think a lot of people expect there could be some type of a deal on the $10,000 cap, given that the Democrats are in control, but also have a lot of constituents who are concerned about this. So, Omri and Vic, what do you think is likely to happen?
I don't know that I have a great crystal ball here. I know there are certainly some House Democrats who've said, I'm not going to vote in favor of the tax bill unless there's a repeal of the cap. I personally think the right strategic move here might be to increase the cap. I feel like Democrats have not made the best arguments in favor of repealing the cap. I think if you think of it as, well, this is going to help the wealthy taxpayers on the coast, that's not a very appealing argument. But if instead you go back to first principles and think about what we're trying to measure in terms of ability to pay, then absolutely you should be deducting your state and local taxes, unless you think that your state and local taxes are really just providing another form of consumption, which you can sort of think of if all of my state and local tax money was going to help schools that my kids go to and help parks that I enjoy, I can see that argument. But in fact, if you look at the reality of most state budgets, most of that is redistributive. That's going to important programs for education and healthcare that, that as California residents, we like to fund these things. And so I think there's a good policy argument in favor of repealing the cap, or at least lifting it up to some more reasonable amount. But I'm just not sure what's going to happen.
Great, thanks. And again, the question of what might happen and what should happen, these are two different questions, and we could definitely spend the rest of the Q&A probably discussing whether it's normatively appropriate to allow the deduction or not. So it sounds like it's a question mark in terms of what will happen, but certainly something that seems very important in these legislative debates and discussions right now. Another comment that we received, I'm not going to say anybody's names who's typing in the questions. That's also to encourage everyone to type in your questions. You don't have to worry about being embarrassed, but I think this is an interesting sentiment. Ugh, I hate this. I do not like the idea of financial institutions wholesale reporting all income and outcome from accounts. Lots of people shouldn't be audited and they will get swept up into audits. And so that's an interesting reaction, because one of the likely criticisms of the bank reporting is the concern about mistakes that might lead to audits, and what you heard earlier, concerns about privacy. We're so concerned about our financial information and our social security numbers and other personal information. This would now be information that a federal agency, the IRS, would have access to. Ex-Commissioner Rosati, I should say, had in his article and in interviews made points that some of this information would be in a secure cloud-based system. Will that really satisfy taxpayers that their bank account information, which is very personal, will really be safe? On the other hand, if we think about audits, people do get swept up into audits when their employers type in the wrong number. And even though you're just earning a paycheck and there was a mistake, or your bank says you received $10,000 of dividend instead of $1,000 because somebody put in an extra zero, you can get swept up in an audit, a correspondence audit. So if there is a headache that comes from this type of bank reporting, again, it may even the playing field between headaches that other taxpayers have had to deal with for a very long time. But I think just the comment and the sentiment is very interesting for us to hear, and I'm sure we'll be hearing more like this. Another question.
If I may add something, even though the concerns is completely justified, to a certain extent, I learned from people that is driven, again, to a certain extent, from unrealistic or wrong understanding of what the IRS is actually doing. It's not that people at the IRS are sitting down and looking over a bank account and trying to find people and audit them. This information is mostly used after the IRS knows something is already wrong, or at least suspect that there is something wrong, and then it uses the information to try to further make the case against specific taxpayer. This doesn't mean that bad things doesn't happen. Of course, bad things do happen. And so the main concern that I personally relate to is that it creates a honeypot for bad people to try to reach this information, which requires us that we demand from the IRS will protect our information, of course. But personally, I wouldn't be very concerned about the IRS having this information, knowing how the IRS actually operates.
And the IRS already does have some personal information about you. I mean, they do have your
most
tax
of
return.
it, yeah. So
and they probably know more about you than anybody else in the federal government. Another question that we got was about the Biden administration's step up in basis repeal proposal. So the question basically is, how is this going to work? Is it really that death is a realization event, or the language from the proposal seems to say that only certain gains are going to get this treatment, gains in excess of $1 million or $2.5 million per couple when combined with different existing real estate exemptions? And also, what about property that gets contributed to charity? So it doesn't actually get passed on to heirs, but it gets contributed to to charity. Does anybody want to respond to this? The basic question is asking, how will this repeal of the step up in basis work?
Yeah, I was projecting a little bit of what I think the right answer is, which I think clearly the right answer in my mind is to treat any disposition by gift or bequest as a recognition event. I think that the administration in its proposal has sort of left the door open to other approaches. One approach that has been tried in the past in proposed legislation years ago was carryover basis, where your heirs would, instead of facing a tax recognition event, heirs would take a carryover low basis in property. I think Congressman Neal has at least opened the door to discussion of having some kind of a deferral of the tax payments for family businesses that remain in the family when they're passed down. And so I think that's the sort of thing that's going to be addressed as this moves over to the House and the Senate. And I think you will probably see some significant carve-outs for family farms, for family businesses, higher thresholds. But I think the core idea of treating disposition by gift or bequest as a recognition event, I think that is likely to be the end result given those carve-outs.
Well, thanks very much, Vic, and thank you, Omri. Unfortunately, we're at the end of our time for this evening. I want to thank Vic Fleischer and Omri Marian and Jillian Henry and Marianne Soden at UCI Law for organizing this event, and thank all of you for joining us. I also want to say in our last minute, as you can tell, there is a lot of activity in tax right now, and at UCI Law, we are very excited about tax. We have had the great privilege to be part of the UCI Law Graduate Tax Program, which is now entering this fall will be its third academic year of existence. And in this short time, thanks to the heroic efforts of my colleagues, and especially our academic director, Omri Marian, and our executive director, Natasha Fastabend, our graduate tax program is currently ranked number 5 among all graduate tax programs in the country by US News and World Report. And our tax area is number 6 nationally in the US. And we would love to have anybody who is a student on this call come join us and study with us. Or if you know students who might be interested in joining us, we are accepting applications until July 1st of this year for our class that will start this fall semester. If you're interested in learning more about our program, please email any of us, or again, Natasha Fastabend is our executive director. But if you just type UCI Law Tax in Google, you'll find us immediately. I also want to just mention at the very end, if you're dialing in by phone, please again, email us at ucilaw@law.uci.edu with your name and your phone number. And we just need that information so that we can make sure to get you CLE credit for participating in this event. And with that, we are at the conclusion of our time tonight. Thank you all for joining us. We have a lot of exciting tax developments to keep track of over the next several months. And hopefully, maybe a year from now, we can look back and see what this Tax Reform Act actually did and how we feel about it after it's been enacted. So thank you very much. And we look forward to seeing you again soon. Take care, everyone.